Dann kündige ich hiermit unseren heutigen Gastsprecher an, ja, Herrn Thomas Jeegers. Thomas ist, glaube ich, bekannt durch sein Buch geworden, Understanding Crypto Fundamentals. Vielleicht kurz zum Hintergrund. Ich glaube, du hast in verschiedenen katholischen Universitäten studiert, also da ähneln wir uns. Und dann auch INSEAD gemacht für deinen Master. Ja. Hast dann dazwischen oder danach gearbeitet als Risk Manager bei ING DIBA, ja, genau. Und zuletzt Country Finance Manager für Österreich von GlaxoSmithKline.
Ganz genau.
Ja? Und weiß nicht, ob man schon mehr sagen soll oder ob das jetzt einmal reicht.
Zurzeit das war's.
Ja. Das, okay. Gut, dann ja, without further ado, Thomas wird uns heute einige Möglichkeiten beschreiben, wie man Bitcoin bewerten kann, was der Wert ist. Wir haben uns vorher geeinigt, ich werde auch noch sozusagen meine Lieblingsmethodologie vorstellen. Es gibt ja viele Bewertungsmethodologien und mit dem übergebe ich dann gleich das Wort an den Thomas.
Dankeschön. Super, danke schön. First thing first, the presentation will be in English. I hope that was clear to everybody as it was announced in the online. Thank you very much, Hubertus. All right, you mind if I stand? I always prefer. All right. So, well, thank you for the opportunity to talk today, to talk about Bitcoin. I mean, people are looking at Bitcoin a lot lately, mostly through the price actions. That may not be the most interesting side of Bitcoin, in my opinion, but nevertheless, this is something very important that a lot of people have in mind. And indeed, price action has been pretty intense lately. So, as you may know, Bitcoin price has increased by 20% in the last 90 days, by 45% since the beginning of the year. It has roughly tripled since last year. And if you go further in the past, it's even a lot more. For example, Bitcoin price has increased by a factor of 12 since the beginning of the pandemic, a factor of 100 since 2017. It was multiplied by 1,000 since 2013, and the price was multiplied by 1 million since 2010. So definitely something that has attracted a lot of people in the space, and that has created some hype. However, whenever there is some hype, it's worth taking a break, taking a step back and asking yourself why an investment has value in the first place. Why does it provide real economic value? And a few years ago, I decided to dive down that rabbit hole quite deep, and over 1,000 hours of research later, I got a book published on the topic, and that's precisely what I would like to talk to you about tonight. Why does Bitcoin have value in the first place, and how do you measure this value? The book has a title, Crypto, in it, but it logically concludes with a focus on Bitcoin that we may cover later today. But today will be exclusively Bitcoin, of course. All right, so at its core, for those who are already deep in Bitcoin, so I'm taking a few minutes to really set the scene, the real fundamental principles, but we will go much deeper fairly quickly. So at its core, Bitcoin offers the ability to transact value digitally without requiring a third party. So something that was previously not possible. If you have your typical bank account or using PayPal, you have to use a third party. Indeed, the bank or the company is debiting your account when you send money and crediting the account of the receiver. You are not sending the money peer-to-peer. It's not like a cash transaction where I give you a bill of 100 euros and you have it with nobody in between. Now with Bitcoin, for the first time, this is possible. The same way you would transact cash, so digitally from hand to hand, you can do that online. Good. So Bitcoin is actually two things. It is both a network and an asset. So let's dive into each of them. As a network, so Bitcoin is a payment infrastructure that is public. Public in the sense that it is available to all without any barriers to entry. So anybody in the world can create a Bitcoin address at no cost and start receiving value from anybody else, regardless of gender, race, religion, or political opinion, And in that sense, it is public. The same way the internet is a public infrastructure for sending information online, Bitcoin is the first public infrastructure for sending value online. Good. So that's Bitcoin as a network. Now, Bitcoin is also an asset. It is a monetary asset, but a monetary asset that does not have any central bank behind it. And that has huge consequences. Because contrary to your fiat currencies, like euros or dollars that you are using every day, Bitcoin does not have a centralized entity that can print more units of the currency and therefore devalue that currency. Just going through my notes to make sure that I'm not forgetting anything. So it is thereby an asset that is scarce, a digital asset that is scarce. And for the first time, we have an asset that is both digital and that is genuinely scarce. I'm saying here genuinely scarce because you need to compare that to, for example, euros that are only artificially scarce. You have indeed a central bank that is only printing a certain amount of the currency, and anybody else cannot choose how much will be printed. Therefore, there is scarcity, but it is maintained by a certain party. Bitcoin, in contrast, has natural scarcity. There is a certain number of Bitcoin that will ever be mined, 21 million, and there is nothing that anybody can do about it. This 21 million ultimate number of Bitcoin that will exist is secured by code and secured by the most powerful network in the world. So there are computers around the world that are expensing real energy in order to secure the Bitcoin blockchain and therefore hold the tenets by which Bitcoin is working, namely the fact that there will only ever be 21 million Bitcoin. Now, Bitcoin also benefits from an extremely high amount of decentralization. It is, for the first time, we have something digital that can be considered a commodity. So a commodity, an asset without an issuer, the same way you have gold or oil, that is generally an asset without an issuer. Now we have Bitcoin that is similar to that, but that is digital. All right. It combines many very interesting characteristics. So I mentioned fixed supply. It is also an asset that is fully transparent. First, the code of Bitcoin is fully open source, so anybody can see the entire code online in real time. But also every transaction on the Bitcoin blockchain are fully transparent, visible by anybody on the network in real time. Something also very different from any type of money or even any other type of asset that we are seeing today. So I mentioned that it is decentralized, and a consequence of that is that it is independent from any political agenda and therefore very difficult to censor by any government or by any company or by any bank or anything like this. So it's hard to confiscate and hard to censor. So those are the key building blocks that make Bitcoin. Now, consequences of that are very big. The first thing that people typically ask is Bitcoin money? Well, let's look at it from the functions of money. Money is supposed typically to fulfill three functions: a store value, a medium of exchange, and a unit of account. In that respect, let's be honest, Bitcoin is not always fulfilling this function perfectly. Indeed, it is not always a stable store of value over the short term. It is not accepted by many people if you try to pay with it, and in that sense, it is not a perfect medium of exchange. And there are very few other goods that are priced in terms of Bitcoin. And therefore, it is not a unit of account yet. Nevertheless, it's very interesting to look at what kind of assets can be money and what kind of characteristics make good money. So already over 2,000 years ago, Aristotle had identified 6 key characteristics of money, including the fact that money should be durable. That's why you typically do not pay with eggs, because eggs, they will rot fairly quickly. They are not a durable asset. Gold, for example, in contrast, has much higher durability because its chemical properties make it virtually indestructible, and therefore you will be able to keep a gold coin for a very, very long time. Good money also needs to be portable. That's why, for example, a house is not practical. Even gold coins, if you try to pay the equivalent of €1 million in gold coins, that's not easy to transport. Bitcoin, in contrast, can be transported in a mobile phone. You can transport and send the equivalent of billions just by the press of a button on your mobile phone. Good money needs to be divisible. So a €1 coin can be split into 100 cents. A gold coin is not very well divisible, not accurately at least. But Bitcoin, in contrast, can be divided into many subunits. So one Bitcoin is currently divisible in 100 million satoshis. So it is a subunit of Bitcoin. And actually, with layer 2 networks, like the Lightning Network, you can even subdivide satoshis further. So all this to say that Bitcoin has a divisibility that is basically infinite and perfect. So on that characteristics, it definitely also plays very well. Next characteristic of good money is fungibility, meaning that two units of the currency need to be interchangeable. So €1 is worth the same as another euro. Two houses are not worth the same because they will have different characteristics. They have a different address, so one is not the same as the other. One Bitcoin, however, is perfectly fungible with another Bitcoin. So Bitcoin has perfect portability, durability, divisibility, and fungibility. It's not perfect though. Good money needs to be accepted. Bitcoin is improving. There are more and more people that are accepting Bitcoin as payment across the world. So far, we are still relatively early in that history, and this is one of the characteristics that still needs to evolve quite a bit. The last one to mention is scarcity. So, good money needs to be scarce. Gold, for example, is a commodity that is very difficult to replicate. If you want more gold, you need to mine it, which is a very costly and time-intensive process. So that's why the total amount of gold available is relatively scarce. That's why gold, for the best part of the last 5 millennia, has been money by excellence. It has been the reference layer 0 of money. Fiat currencies, in contrast, have a very poor level of scarcity. Just since the beginning of the pandemic, the amount of euros or the amount of US dollar that are in circulation has increased drastically. I don't have the exact figure right now, but by a high 2-digit amount of percentage. There's a book called The Seventh Property by Eric Yates, where beyond these 6 properties, he also mentions something else that should be considered as part of characteristics of money. Basically the fact that good money should offer permanent settlement. If we make a transaction in cash and we both leave, we cannot reverse the transaction. In contrast, if you are making a payment with a credit card, it often takes weeks or even months for the transaction to settle, and sometimes it can be reversed. Now, Bitcoin, in contrast, once you make a transaction on the Bitcoin network, once it has been validated, so added in the next block on the blockchain, well, it is permanent. You cannot reverse that transaction. This is something very important that also adds value and adds credibility to how Bitcoin could become money. And there's one more that I would like to discuss here. It's in terms of accessibility. So unfortunately, for many people in the world, access to money is not a given, because the fiat currencies that their government are using are not such that they can get their hand on it, or they can be censored out of the system. and therefore they can really use that money. Now, good money, that's a personal opinion, should be publicly accessible. It should be something, a good that everybody has access to and that is reachable and usable by everybody, regardless of what anybody else can say about it. And Bitcoin provides some higher level of accessibility publicly than anything else that we know so far. So is Bitcoin money? Currently not, at least not perfect. Can it be money? Well, based on the characteristics of good money, it is by far the best asset that would qualify as good money that we have ever had. I have a valuation method that I will show you later, in which it also makes the case against gold on how it can become an even scarcer asset and therefore even better money. Before we dive into valuation methods, there are two things that I would like to discuss. A few years ago, there was a lot of fear and we can say fear, uncertainty, and doubts around the usage of energy by the Bitcoin network. The fact that Bitcoin is very energy intensive, so to secure the network, you need to use a lot of energy. So this is a Bitcoin miner. This is a device the size of a toaster that consumes the energy of a house, or more than that, or 3 houses actually. And it's only doing one thing. It's only securing the Bitcoin network by computing, let's say, a simple mathematical problem. So yes, Bitcoin uses energy. However, in order to mine Bitcoin profitably, you need to have access to a source of energy that is incredibly cheap. A source of energy that is so cheap that if you could do anything else with that energy, you would be better off doing something else than mining Bitcoin with that energy. So the only energy that is used to mine Bitcoin is basically energy that you cannot do anything else with. It's typically stranded energy. Let me give you an example. And let's take a purely theoretical example. On the Danube here, imagine you have a hydropower plant. During the day, while the Danube is flowing, it's producing energy, and that energy is sold to the electricity grid of Vienna. For example, to light up this room, we are buying electricity at roughly 45 cents a kilowatt hour, roughly. In contrast, to mine Bitcoin profitably, you need to have access to a source of energy that will cost you less than 7 or 8 cents per kilowatt hour. So during the day, the energy produced is of course sold for 45 cents on the electricity grid of Vienna. During the night, however, when there is very, very low demand on the electricity grid, the Danube is still flowing. It works the same way with wind energy on wind farms. So during the night you have electricity that is produced that nobody can use, and therefore the renewable power plants have this extra energy they cannot do anything with, and actually they even need to pay in order to get rid of this energy. Such renewable power plants are typically profitable less than 8 hours a day, roughly neutral 8 hours a day, and are losing money 8 hours a day. Now, with Bitcoin miners, you install them along the hydropower plant, and when there is no demand on the grid, you plug the Bitcoin miner in, and you use the extra energy to mine Bitcoin. What does it do? Well, first, you make money out of it by mining Bitcoin and therefore getting Bitcoin rewards. And secondly, you do not need to get rid of this extra energy that you have no use for. So yes, Bitcoin is energy intensive, but it is using electricity that you cannot do anything else with, and mostly using renewables. That's why the large majority of the energy used to mine Bitcoin is renewable energy, much more than for any major country in the world, much more than for most technologies. And this actually has very important consequences, because if I'm the owner of the hydropower plant, I used to be profitable maybe 8 hours a day at best. Now I'm profitable basically all day long. So what do? Well, I will probably invest a lot more into these kind of renewable power plants. Instead of having one, I will buy 5 more. And then all of a sudden, there's a lot more renewable power plants that are available on one hand for mining Bitcoin when there's no demand, but on the other hand also for providing electricity to the grid outside of, so when there is demand. So it is increasing significantly the amount of renewable infrastructure that is existing. So Bitcoin finances renewable infrastructure. It is not wasting energy, quite the opposite. If you care about the environment, if you care about having more renewable, Bitcoin is actually one of the best use cases for that. That brings me to an example I heard about recently, about the country of Malawi, where only about 11% of the population has access to electricity. And even those who have access are facing blackouts, often like 6 or 8 hours a day. So, another very important topic for me is Bitcoin as an ESG asset. So here, let me take another example. For the past 850 days, roughly, since the Taliban took over control in Afghanistan, they have prevented young girls to be able to go to school. Now, these human rights activists are using Bitcoin in order to get funding and in order to reach some great things. For example, literacy for girls that do not have access to it otherwise. So Bitcoin is basically removing the government, so removing the hands of the government from their grasp on money. It is not money for criminals, as you have probably seen in some cheap newspaper. It is money for human rights activists trying to fight criminals. And this is something that, in my eyes, also has a lot of value for Bitcoin. And that's very important behind just the price action that we are seeing every day. Now, those are just a few of many possible reasons why Bitcoin has value in the first place. The big question is, how do you value this? How do you value it? First one I like to present is the stock-to-flow model. So, in 2019, a Dutch institutional investor by the nickname Plan B have used a traditional valuation method that was used for commodities and has applied it for Bitcoin, because he understood Bitcoin is actually kind of decentralized, it's kind of a commodity that could make sense. So he just looked at what would the stock-to-flow mean for Bitcoin. Let me explain how it works. So it's a model that values scarcity. And it has two components. First, the stock of an asset is the total quantity available of the asset. So how much has been mined since the beginning of time. Take gold, for example. The total quantity of gold that has ever been mined is about 200,000 tons. Yeah? And as I mentioned, gold has chemical characteristics making it virtually indestructible, meaning that every piece of gold that is mined in a year is just adding to the stock that keeps going up over time. It's not like copper or iron that rusts and therefore that the stock decreases. It's not like silver, for example, that can be used in many industrial processes and therefore you do not accumulate a large stock over time. Gold has this characteristic that a very large stock could be accumulated over time. The second characteristic in this model, second input in this model, is the flow. So that's how much is mined in a year. In the case of gold, for example, literally how many units, tons, grams of gold are mined in a year and added to the stock. Now, the logic is that the higher the ratio, the higher the stock compared to the flow, the more scarce the asset is. And typically, a scarcer asset in terms of its stock to flow, a scarcer asset is linked to higher valuation. So that has worked very well for commodities for many decades, and then it was applied to Bitcoin in 2019. So let's take first the example of gold. So I just checked the latest data from the World Gold Council. As I mentioned, about 200,000 tons of gold have been mined since the beginning of time or are available today. There are about 3,000 tons of gold that are mined in a year, so that's the average per year of the last 10 years. And therefore the stock to flow, one divided by the other, is roughly 60. Alright. It's important to note that from any asset, gold has always been the asset with the, by far, the largest stock to flow ratio. So I mentioned, because of the characteristic of the stock that keeps accumulating, and because of the fact that the flow is costly and time intensive to produce, gold ended up with being the highest stock to flow asset. And therefore, it was the asset that was the most appropriate to be the base layer for money, precisely because it was scarce, because people could not easily produce more of it. If you can produce a lot more of an asset in a short period of time, then your asset is not scarce per se. Because it's not scarce because, if you have, let's say, 1 unit, or 100 units of it, if another 100 units can be produced in a year, well, the amount that you have becomes a much smaller fraction of the total amount available. And therefore, gold with this high stock to flow ratio was the optimal asset for to be used as money. Now, there are two ways to interpret the stock to flow. It is the number of years that it takes to double the stock at the current rate of the flow. So if we keep mining roughly 3,000 tons of gold per year, for 60 years you will double the amount of gold available, 200,000 tons. Now, what it means for Bitcoin. First, the situation last month, so when there was the fourth halving of the supply, on the 20th of April. So you had 210,000 blocks on the Bitcoin blockchain that were mined with each 50 Bitcoins in them, and 210,000 blocks with 25 Bitcoin in each, and so on. So they were 19.7 million Bitcoin that had been mined so far. Now, the flow is how much new Bitcoin is mined in a year. So, at that point, 6.25 Bitcoin per block, roughly 6 blocks per hour, because there is 1 block every 10 minutes. 24 hours in a day, 365 days in a year, that gives you 328,500 new Bitcoins every year. So, the 4 years that ended last month. And therefore, the stock to flow of Bitcoin at the halving last month was, for the first time, flirting with the stock to flow ratio of gold. So first time in history that we have an asset, a commodity, whose stock to flow is coming anywhere close to the stock to flow ratio of gold. Now, after the halving, let's say 1 year after the halving, what will that look like? So again, you have the same beginning for the stock, and you add 1 year of mining Bitcoin with the new Bitcoin reward, so a bit more stock, not much more stock. The flow, however, has dropped by a factor of 2, because the first 3 terms are the same, but now you only have half of the reward, so your flow is much lower, and therefore the stock to flow ratio of Bitcoin next year, so 1 year after the halving, will be 120. So twice the stock to flow ratio of gold. First time in the history of humanity that we are seeing a flip of the asset that is the scarcest in terms of stock to flow. So, what does that mean in terms of prices? So when the model was applied for the first time to Bitcoin, that's what it looked like. You had Bitcoin price in blue. Of course, I'm using a logarithmic scale here because that's the only way to express accurately the price of an asset growing exponentially. So you see the price of Bitcoin growing from below 1 euro, it's in dollar, below $1 to it was roughly $8,000 in 2019, and you see in dotted yellow the stock to flow model. So you can see every 4 years there are these increase over a 1 year period in the stock to flow. That's the year after the halving. So as the reward decreases, divided by 2, of course the stock to flow is doubling. And that model therefore predicts roughly, a large increase in the price of Bitcoin after every halving. So that's when the model was created. There was a lot of criticism. People were saying no way Bitcoin goes at that kind of level. And it was predicted in the 50,000 and so on in 2021. Now, you know how history played out. That's what happened. So almost like clockwork, when the third Bitcoin halving happened in 2020, the price skyrocketed almost perfectly along what the stock to flow model was saying, and landing almost perfectly where it was saying that it was landing. So we had spikes at 60-something thousand. Then the year 2022 happened. So there were several corporate figures in the crypto world. So Three Arrows Capital, FTX, and the likes. And there were lots of fear. People withdrew their money, and price of Bitcoin dropped to below 20,000. Now, for the last 18 months or so, it has recovered and is now back exactly where the stock to flow model was predicting that it would be. Now, the halving has just happened. If this model is correct, and so far it has had an incredibly goodness of fit, if this model is correct, it's predicting that the price of Bitcoin would skyrocket to $400,000 to $500,000 per Bitcoin once the fourth halving is priced in. And I'm stopping the graph here at the fifth halving, but actually after that you can imagine it's going up further. It's therefore predicting a price for Bitcoin largely superior to $1 million by the end of the decade, so once the fifth halving is priced in. A few takeaways from this model. First of all, it has worked exceptionally well in the past, both for past data and also predictive. So from 2019 to 2024, it has worked extremely well. So I mentioned the price target that this model is saying. It's not what I'm saying, it's what the model is saying. However, and I need to make this very important caveat, this model is not perfect. It's only taking 3 inputs: time, stock to flow ratio, and past prices. Nothing else. So it's not taking regulation into consideration, it's not taking technological developments, it's not taking any other factors. The model will not work forever. At some point it will decouple, so the price of Bitcoin will decouple from the stock to flow model. The question is when. And actually the author with whom I was personally in contact has developed another model a few months later, so not even a year later. It was the stock to flow cross asset model. Basically, he was asking himself, look, it looks nice for when you just look at Bitcoin, but what would it look like if you compare it to other assets? Can you add other assets in the mix and to try to challenge his own model? So he looked at the two, let's say, most used, almost now commodities, gold and silver. And he decided to extend his model with this. So it was in April 2020, just a year after his previous model. So his logic was the following. If you take money, there's also an evolution at different stages. Money used to be gold coins, something hard. Then it was paper money that was backed by something real, gold. And then afterwards it became paper money not backed by anything, or backed by trust in the government. That's the idea. And now let's look at how the different stages would have looked like for Bitcoin. So Bitcoin also went through several phases in its history since the last 15 years when it was created. First, it needed to be a proof of concept. Alright. Then there was a narrative. Bitcoin was basically a cheap payment network. Okay, fair enough. Then there was the darknet history, so it was used, for example, for what's the name? Silk Road, and for other websites. Then people started saying, well, it's a kind of censorship resistant gold, it's electronic gold of some sort, it's a reserve currency for crypto. Then later people started saying, yeah, it's a programmable shared database or it's an uncorrelated financial asset. So there were several phases in the history of the narrative of Bitcoin. And actually you can identify 4 different phases. Proof of concept, Bitcoin as payment, Bitcoin as electronic gold, and Bitcoin as a financial asset. Now here on the graph, Plan B has put 2 things. So first, vertically, still with a logarithmic scale, you have the price, so the market value of Bitcoin, and horizontally you have the stock to flow ratio. And then he dotted every month of Bitcoin where it was. And you can clearly identify 4 clusters. So a clear correlation and 4 clusters that would correspond to the 4 narratives. That was his theory. Alright, as the stock to flow evolves, you have market value that evolves, and that follows the narrative, the 4 stages of Bitcoin. Now, how does it look if you add gold and silver to that? So he added silver market cap and stock to flow ratio in gray, and then he added gold market cap and stock to flow ratio. And somehow it almost perfectly fits the model. Actually, so if you have some statistical background, the coefficient of determination, R squared, is actually 99%. So there is a very clear correlation between stock to flow and market value. A big question is whether correlation means causation here, or whether there's anything else causing this. At the very least, what the stock to flow cross-asset model is saying is that there is something behind it. The stock to flow seems to have a clear impact on the valuation of the asset, and it seems to be validated by external, so non-Bitcoin, real-world asset. Alright. Key takeaways. So, they were focused around the 4 narratives. This confirms the trend that we have seen with stock to flow ratio. So gold and silver are perfectly in line with the identified correlation. And still, we are now 4 years after the publication of this model, and Bitcoin valuation seems to be still perfectly in line with this. So Bitcoin is now roughly at the same place where silver is, so same valuation, same total market capitalization as silver, and roughly same stock to flow ratio. Alright, that was it on the stock to flow. Another valuation method that is very important is to look at Bitcoin in terms of adoption, so technology that is being adopted. So you may be familiar with Metcalfe's law. Robert Metcalfe is a co-inventor of the Ethernet, so father of the modern Internet, and he was establishing that let me take the example, it's probably easier first. If there's only one telephone in the world, it does not have much value because you have nobody to call. When there's another person to call, so another telephone, well, you have a person to call, so yours become more valuable. With every new person with a telephone, your phone becomes more valuable because you have more people to call. Yeah? And the same works for social media. If you are the only person in the world on Facebook, it has no value. But with every new person on Facebook, well, the network becomes more valuable. The same goes for Uber, for Twitter, and so on. So it's what Metcalfe is trying to represent is that the value of the networks grows exponentially with the number of nodes. So the more people join the network, the more it becomes valuable for every user. Yeah? And that's precisely what Bitcoin is also achieving. So network effect. Every new Bitcoin user is adding value for anybody who wants to accept Bitcoin as a payment method, and every person who accepts Bitcoin as a payment method is adding value to every Bitcoin user. All innovations follow typically this pattern, where you have innovators, then people, so early adopters, early majority with people adopting it at a faster rate, and then people adopting it again later as you go through the innovation time. For example, take mobile phone, the first people to get the iPhone and so on, then it goes very quickly. And these people, they will only get the iPhone when their old, digital phone, dial phone is no longer available. So the total number of people on the innovation will grow as an S-curve. That has been seen for hundreds of years with all types of innovation. Adoption of the coffee machine, the washing machine, internet, mobile phone, just name it. Basically all innovation goes through these patterns. Of course, the time to adoption is different. But what this model is saying is that with a typical S-curve, the time it takes to get from 0 to 10% adoption is typically the same time as the time it takes to get from 10% to 90% adoption. Alright, so Bitcoin to get from 0 to 10% adoption, here it's measured as 10% of people under 35 years of age who have access to the internet. So to go from 0 to 10% adoption. Sorry, it's in the case of crypto, not Bitcoin here, but logic is the same. Is the same as the time it would take to go from 10% to 90%. So it took 13 years, from 2009 to 2022, to get to 10%. So this model would suggest that it takes another 13 years to get from 10% to 90%. Of course, you can imagine the kind of boost that it would give to Bitcoin if you multiply the user base by 9 in the coming 13 years. I mentioned in the introduction that the internet was, for the first time, sharing, so the ability to share information online. And Bitcoin is, for the first time, the ability to share value online in a completely decentralized way. And Bitcoin and the internet are actually very interesting because, let's say, one way of looking at the adoption schedule of each is very similar. So here I've shown again Bitcoin price. So you have the logarithmic scale vertically and the Bitcoin years at the bottom. Now, I have shifted the years by 16 years up there, and I have the internet adoption years and the internet adoption in percentage. From what was it, like less than 1% in the early 90s to reaching 10% in the early 2000s, and now at the 70% growth. And what you can see is that with the 16 years delay, they both seem to follow a similar trajectory of a logarithmic curve while you're showing it on a logarithmic scale. Yeah? Of course, it's a very simplistic model, but there is something to it because the two have a similar logic. One is for information, the other is for value, and they are both, something decentralized, online, and how people can share things peer-to-peer. So this very simplistic model would suggest that if you actually follow the internet adoption curve and use the Bitcoin years, so by the end of the decade, you would be roughly at $1 million per Bitcoin, according to this very simplistic model. So at the very least, it is confirming or adding security to what we were looking before with the stock-to-flow and stock-to-flow gross asset. All right. Let me present a last one that I think is probably the most intuitive one to understand. Bitcoin, I mentioned, is not a store of value in the short term because it fluctuates. However, it offers some characteristics of a very good money and a very good store of value for the long term. It has worked exceptionally well in the past, and many people expect it to work very well in the future. For reasons that I've mentioned, stock-to-flow and others. Now, let's look at the market for store of value. Here I've taken the most conservative estimate you can imagine. So actually, if you take more reasonable or more aggressive estimates for each bucket, it would even suggest even higher valuation. So you have total crypto market, roughly a bit more than $2 trillion, Bitcoin being half of it. The total gold market is 12 trillion. You have stock and bond, each at least 100 trillion. Honestly, estimates from bonds go even to 300 trillion, depending on how you count it. And then real estate at least 300 trillion dollars for real estate. So as you can see, Bitcoin as a fraction of the total store of value market is a tiny fraction. Now, the question you need to ask yourself here is, if Bitcoin was capturing just 3% of the store of value functions of these other assets, what would be the price of Bitcoin? So you have roughly 500 trillion, so well beyond that, but let's say 500 trillion, 3% of that would be 15 trillion, so you would multiply the market valuation of Bitcoin by at least a factor of 10, and therefore multiply the price of Bitcoin by at least a factor of 10. Now, the figures I'm showing here, it also suggests that if you say roughly 3% by the end of the decade, so if Bitcoin were to capture 3% of the store value functions of these assets by the end of the decade, then the price of Bitcoin would be largely superior to $1 million per Bitcoin. And this is assuming 21 million Bitcoin. Actually, we know that roughly 20% of all Bitcoins in existence have been lost already. So actually we should divide it by 16 million Bitcoin, and therefore it would give a valuation even higher. And again, those are conservative estimates. So feel free to put your own estimates in this, but at the very least, this confirms what the previous model have been presenting, that the fair value for Bitcoin is largely superior to its current trading price. There are other things that you might consider as valuation methods, and I'm mentioning some of them in the book. Bitcoin is considered a cybersecurity protocol. That also has value, and honestly, it's almost impossible to measure it, but it can have enormous value that come on top of what I've been presenting, for example, as a store value. There's a guy called Greg Foss, that I know personally, that has created an index called the Fulcrum Index. That's basically a credit default swap against government bonds, and therefore also an insurance against sovereign debt default. And he has been showing that Bitcoin is actually following exactly that index. So the more you have large governments in the world that come close to default, the more the price of Bitcoin increases, because indeed if a US dollar or a euro was to default, so was to fall into insignificance, indeed Bitcoin would be used possibly as an alternative, and therefore its valuation could go up. So that's another way of measuring and valuing Bitcoin. There are other methods as well that I describe in the book, and that many are describing in online forums and outside. Let me stop here. Hubertus.
Thank you.
Yep, there we go.
So, now that we had these interesting and convincing curves, let's have a look at these curves, right? So, and Thomas already mentioned it. One of the things which we really should be very aware of is the question of correlation versus causation in this context. Yeah? So we know that, but what does it actually mean? Yeah? So let's look at one. So we have, for instance, a fantastic regression of per capita cheese consumption versus people who died becoming tangled in the bed sheets, also in the Bettwäsche ermordet haben. Yeah? And we can see this has a very nice correlation. So it definitely says we should eat less dairy. But we don't believe it. Like Thomas, we do a cross-asset correlation. Yeah? So if you do a Bitcoin, we must also look at gold. In our case, for dairy, we look at the sour cream consumption, as a Sauerrahm. versus motorcycle deaths in non-collision transport accidents. And you can see this also has a similarly high correlation of 99%. So now it's all clear, it is confirmed, dairy is really bad if you want to, so to say, increase the lifespan of your people. Let's go vegan. Now, on the other hand, you know, there are these awful detractors of dairy who say, I don't really believe in this vegan shit, excuse me, I mean, check it. So what we're going to do is, we're now checking the correlation between the divorce rate, Scheidungsrate, versus the consumption of margarine. And this actually has a 99.26% correlation. So, yeah. And now you have this typical Twitter space. On one side of the Twitter space you'll have the vegans, on the other side you'll have the dairy lovers. And there's always going to be conflict. Elections are going to be terrible. One side will side with one of the parties. I'd say vegan, go Democrat. Yeah? The dairies will go with the Republicans. It's enough time to fight. Sometimes it's even more difficult. Like for instance, here's one which might be related, right? Like US crude oil imports from Norway into the US versus drivers killed in collision with railway trains. I mean, there seems to be some connection because you need fuel to drive cars. So what the important thing is, when we look at these causation things, if somebody tells you a curve without being very explicit how the causality works, don't accept it. In Austria we have the Burgenland. Yeah, most people will know that. It's this. You are from Belgium, so you probably don't know that. We have this very flat area in Austria, and there are storks which come from Africa every year and build a nest there. And unfortunately, as we all know, the storks bring the babies. And in Burgenland, as there were less and less storks over the past decades of years, the number of babies sank too, which obviously proves that the causality that storks bring babies. So that's a problem. Now, of course, it doesn't mean the population will now decline too, because not only the storks come from Africa, other people too. Anyway, but then there are other causalities. For instance, we do know that the number of heart attacks and strokes is declining with the usage of blood diluting medication, like aspirin. But there, we know the mechanism. We know that aspirin thins the blood. It works against platelets, so there's a reason for it. We know that with age, the blood system gets a little bit clogged up here and there, and so that's why you have less heart attacks if you have it. So you have a theory which tallies with the correlation. So, being there, I took a few notes while Thomas's speech, and now let's see some of these theories. So let's look at stock to flow ratio. If we take it to the extreme, yeah, and let's assume that Bitcoin, for some reason, will not become medium of exchange. Let's assume Bitcredit protocol is not being adopted. Yeah? So we are in the situation that most of the flow will be from the reward, which will go away, and then we'll have, I don't know, even the runes and the BRC20, for those who know these new tokens, activity is not sustainable, as we know. It's going back already. So you have transaction fees. How much do we want? 0.01 Bitcoin, I think, yeah. So, but essentially it's so small versus to the stock that essentially the value would be almost infinite, which is of course rubbish. So things have to happen. Causality must happen. The other question, which of course is there, is if Bitcoin now has a higher stock to flow ratio than gold, double as high, and gold, which today has a market capitalization of 17.5 trillion, so it's been rising too recently, without much change in the stock to flow. So why are they do different? Then there's the question, Litecoin. Yeah, I mean, Litecoin in a way is also quite fantastic. Yeah. From my notes here, just checking. Well, first of all, it has faster blocks than Bitcoin. There's 84 million of them, but otherwise the mechanics are the same. It uses a better algorithm for the proof of work, and still it's only worth a fraction, only because of 2 years delay. So how to explain? Yeah. Also, we must factor in the fact that gold, for instance, essentially over millennia, had the same price in the real terms. So if you had an aureus during the times of Julius Caesar, yeah, it bought you, I don't know, so and so much in wheat. And if you went to the time just before fiat started, 1913, 1914, it still bought you pretty much the same amount. Then there was agricultural revolution, blah, blah, blah. But it didn't really change much. That money is special. Money is really the only system which can completely detach from the commodity behind it. Once you have commodity money and credit money, and let's ignore fiat money because that's detached anyway. But if you issue more credit money on a commodity money standard, you can change the price. It changes the price simply. In fact, if it's done correctly, it will stabilize the price. Because while the demand for 21 million Bitcoin may change a little bit, as a currency on Bitcoin would be elastic, so it would adjust to demand, which would mean that once you add credit money to Bitcoin commodity money, Bitcoin will stabilize, just like gold stabilized between 1700 something and 1913, when it was always $20 exactly. And not to mention, it was pretty much the same real purchasing power back to Roman times. So no such thing as stock to float. Now, what does that mean? Well, let's assume for a moment that stock to flow works. Yeah, it's possible. Yeah, it's a mathematical thing which maybe we just don't understand the causality. So what is it? I mean, one thing which we do know is that government reliably erases the fiat money. And more of the stuff, we saw a currency crisis, we saw inflation crisis. There's lots of reasons, tendencies, which go in parallel with the Bitcoin adoption without necessarily being completely causality connected. Because there's only a certain percentage of people who can actually afford to invest. And the investing class, particularly in Austria, is not very pronounced, as you know. Then you also know that positive feedback loops reliably cause bubbles. It's a causal effect. If you have a limited supply of something and an increasing demand, the price will go up. Yeah, until it doesn't go up anymore, which we saw in silver. Yeah, so if anybody remembers the story of the Hunt brothers, the Hunt brothers are essentially two brothers, rich heirs of a very, let's say, diligent man who amassed $1 billion or so. And the two brothers, the kids, had a very good idea how to make a lot of money without a lot of work. I mean, that's completely stupid, right? So what they did is they started buying silver because there was a limited supply of silver, limited stock. And as they bought with the $1 billion, of course, the price of silver went up from something like $5 or something until 25. Then it started to get a little bit flattish because they couldn't buy more, it didn't have more effect. So they started to take out loans. Yeah? And they did that until the price of silver actually tenfolded. Because it's a limited supply, it's scarce, and there's just not enough to go around, and people also use it, and you said that, for industrial applications. Problem is, at some stage, loans, they were greedy, at some stage, loans become due, you have to buy back. What happens then?
Sell silver.
You need to sell silver. And what happens to the positive feedback loop once you sell silver? It reverses, yeah? It gets a negative feedback loop. So that one was followed by that one. So to cut the long story short, and there was a decade of lawsuits afterwards, 2 decades, where they were in front of courts with lawyers, blah, blah, blah. Anyway, in the end, the billionaires were luckily still millionaires, but that was the end of the silver corner of the Hunt brothers. So that's when a limited amount of wealth meets a fixed amount of commodity. A network effect, let's cut that, so it's probably not important here. But the causation of the rise of the value of the scarce good in commodity is simply given because the issuer is the government only, yeah? And you cannot issue today. You will be able to do it again soon. But as of today, only the national bank can issue money, and the government forces you to pay the taxes with it and to accept it from anybody who has a debt. Anyway, so what does that mean actually for valuation? Look at it more for a moment, not in graphs, in correlations. Let's look at it from a fundamental point of view. And we do know what money is in the world today. Yeah. We know that the sum of the monies of the central banks, and this is the number now of, no, it's the next page, of assets in 2021. And mind, COVID printing was not yet finished. I don't know if there's the new number already. Anyway, it was $44 trillion. Yeah? So forget about real estate, forget about gold right for a moment, yeah? Stocks and bonds. Let's just see how much money was there. And the M1 money, so the asset side of all the central banks in the world, was $44 trillion. It's good. That's the whole world. So if we assume that Bitcoin takes over the world, or at least has the potential to take over the world, speaking more precisely, then you can essentially say, well, yeah, how much of money in a hard money system, and the gold standard was the last hard money system, how much money is in base money and how much is in credit money? And we know from reports from the gold standard times, Mises wrote about it, he reported a factor of 10% base money, which would be Bitcoin, and 90% credit money, which would be Bitcoin credit, for instance. Yvonne later, he reported 1 to 20. But whatever it is, let's assume 1 to 10. In that case, the value of Bitcoin, the totality of it, would be $4 trillion. And if you divide $4 trillion by 21 million, you get roughly to a price of $210,000 per Bitcoin, if there is a likelihood that it can become what it should become, a medium of exchange. If you don't get that, if something else achieves it, an altcoin, or even worse, the government surveillance and spy coins, CBDCs, then it's dead, then it just evaporates. Yeah, because if you're on a CBDC, you can actually program what you can do with it. And for instance, you could prevent Paolo Arduino from buying treasuries to secure USDT. So that one dies too. So that's $4 trillion. And if you check back on gold money, yeah, the gold, which is right now, with central banks, to back the currency, apart from the bonds, which, let's be honest, are pretty much worthless, is about, I think 17%, I have the number here, 17%. Today's value of gold, Thomas already gave you the number, 208,000 tons of gold. Today's gold price was 2,370 something, the old gold bug. So that gives you a total valuation of all the gold in the world today of 17.5. You still have the last year's numbers. Going up in the rate. Anyway. Yeah. So if you take 17% of that, excuse me, we arrive at a value of 3 trillion. So that's slightly less of the 4.4 trillion. That would give you only $150,000 per Bitcoin, which is still nice. Yeah, it's kind of 2.5 times today's value. So we'll be happy there. On the other hand, you also have to consider the private holdings of gold. Now that one is very hard to, let's say, evaluate, because a lot of it is held because people don't trust central bank money, fiat money. So if you have a trustworthy money again, like was the gold standard, take away government bullshit, or could be the Bitcoin standard, those 25% of today's market cap would be 17.5 trillion, which means we can add that quantity, which brings us to 7.3 trillion divided by 21 million Bitcoin, gives us $350,000 per Bitcoin. I'm not so sure that's going to happen, but it gives you, so to say, an upper range, because the other part of gold is either being used industrially or you need it for your girlfriend. Okay. So yeah, that's essentially an alternative, more fundamental look at the value of Bitcoin without following the curves.